What's up, guys? I hope you're doing well. So just kind of a lot of people have been talking about how the Fed has been so behind the curve in terms of inflation and everything else. It seems kind of like I guess, kind of a typical response in a way. But I found a speech by I think he's relatively new. Um, the new governor, Christopher J. Waller, or yeah, I think that's his name. Sorry, but we'll go back here and I'll just go straight to the screen share of the speech so that we can just get it going. It's this one. Yeah. Okay. But yeah, basically talking about how they're not really behind the curve in a way is what I kind of got from it. Um, and kind of saying, I don't know, because he also says like how the private sector was doing the same thing and so on. I'll just, I don't want to put words into his mouth specifically, so we'll just kind of take the words that came directly out of his mouth. Excuse me. Um, so first, the Fed was not alone in underestimating the strength of inflation that revealed itself in late 2021. Second, to determine whether the Fed was behind the curve, one must take a position on the evolving health of the labor market during 2021. And finally, setting policy in real time can create what appear to be policy errors after the fact due to data revisions. Right. Some of this is, I mean, it's fair, especially like the data revisions. That's understandable. And also, they have a dual mandate. They have to pay attention to the labor market as well, which he gets into, um, and so on. And I guess his whole argument is that, or it seems to be, where he, how to word it, basically, that the Fed can't work off of what they think will happen. They have to basically go off of the data they're already provided. Um, so they're always like looking in the rearview mirror, so to speak. And so that's what it seems, because all the arguments and stuff that I've heard in terms of people talking about how the Fed is behind inflation is they're always like, at least in the beginning, because I remember basically spending like the entire summer of 2021 like listening to podcasts, and it was all about the inflation, what we're going to see later and stuff like that. And it's just every podcast, it was inflation was higher than the one before, and it just kept going. But I guess that's his point. He also, again, the dual mandate, they have to deal with maximum employment and price stability. And so they have to work for both of those goals, not just price stability, is his argument. Um, and then also, it's these monetary policy decisions are based off of a committee, right? The FOMC. And so there's 12 voting members, and then there's 19 participants in the discussion. The participants in discussion who aren't voting are the other Federal Reserve, like the regional bank presidents that aren't in that current rotation. Um, right. And so kind of the whole thing is like, hey, there's 12 of us. So their changes are going to be more gradual, because you actually have to agree on stuff. Um, he talks about how he believed the economy was ready to rip, that it was different than 2008. But this is what really got me kind of, let's see, where he goes into private sector forecast. So there was a range of views on the committee. 11 of my colleagues did not have a rate hike penciled in until after 2023 with regard to future inflation. 13 participants projected inflation in 2022 would be at or below the 2% target. In March of 2021, SEP, I think that's like that report of economic projections, if I'm not mistaken. No committee member expected inflation to be over 3% for 2021. As argued in a speech last December, this view was consistent with many private sector economic forecasts, right? So they're not alone in this, is what he's saying. And this was as of, because he does it like throughout the year. So this was back in March of 2021, in which he's saying this was the general consensus at that time. Um, so Again, all the suspected drivers of this surge in inflation appear to be temporary, the whole transitory stuff. The one-time stimulus from fiscal policy, even though there were multiple different types of stimulus in different rounds as well. Basically, just saying, I guess the one-time stimulus, in the grand scheme of thing, I guess it's like, okay, yeah, there's that one, the event in a way. Um, Even though there were multiple rounds, but in the grand scheme of things, like when you extrapolate like 20, 40, whatever years, it's really only, it's not like you're doing 10 years of transfer payments, I guess. Um, Anyways, and then supply chain shocks, that previous experience indicated would ease soon, and a surge in demand for goods. I mean, what do you expect when everyone's locked in their house for a year? People aren't working in the supply chains, and then there's also people want more stuff. They still need to eat and consume stuff. Um, it changes. Yeah, this is what the SEP, I think it's the Summary of Economic Projections is what it stands for. I couldn't remember what the S stood for. Um, Basically, the consensus changed a little bit to where now, it's, yeah. Also, unlike the March SEP, every committee participant now expected inflation to be over 3% in 2021, and just 5 believed it'd be below 2%. Um, and now they're saying inflation's being, what's the term they used? It's like going to the upside, basically. Um, Started talking about tapering and stuff like that. And this was mid-year 2021. And then at the July FOMC meeting, dang, I cannot talk today. The minutes show that most participants believe that substantial further progress had been made on inflation but not employment. Tapering was not viewed as imminent by most participants. And so this was kind of the whole, they have the dual mandate, so they have to pay attention to employment as well. And then basically at the end of the year with October, that showed that the personal consumption expenditures was actually decreasing. It was slowing. And then they were expecting basically a couple of weak job reports. And in its December meeting, the committee accelerated tapering. And the SEP showed that each individual participant projected an earlier liftoff in 2022 with a median projection of 3 rate hikes in 2022, right? And it's one of the, this next sentence is kind of made a lot of sense, I guess. With these forecasts and forward guidance had a significant effect on rising market interest rates, even though we did nothing with our primary policy tool for Fed funds. And this was in the end of last year, so end of 2021. And I listened to an interesting podcast that it was one of the Eurodollar University ones, and basically it was like, monetary dang, monetary policy nowadays is more psychological than anything else. It's basically based off of like forward guidance, as he's saying here. And so basically trying to answer the question of whether or not we have to have real positive interest rates to actually rein in inflation is arguable, because it's no longer strictly a monetary phenomenon, I guess was the argument, which is kind of, I guess, contrary to the whole Austrian school of thought. But basically the fact that I think the basis of that argument is the fact that, regular inflation, or so, like 2 to, I guess, 3% or so, like kind of, I guess, mild is what you would deem it, is mostly monetary, right? And so it's basically based off of monetary characteristics of supply shocks, whatever that may be, at least in the aggregate total. But when you're starting to look at the much higher changes in inflation, say like now with like 8%, if it goes up to like 9 or 10, or what we dealt with in like the 1940s or in the 1970s, where it's mostly a psychological phenomenon, where there's actually a change in psychology kind of within the general public, um, to where that's kind of the dominating effect when oh my god, what's the name of that law? Basically, when faith is lost in the currency, or at least to some degree. For some reason, the name, I've said it multiple times in videos, and I just can't remember the name right now. Um, but yeah, basically, people just losing faith in the currency and such. And then you just see that kind of that change in psychology. And that's really what induces those higher like rates of inflation per se, because everyone's trying to spend as much as possible because they know it's going to be worth less than before. Um, so pretty much it. Um, basically, says they're not really behind the curve because of the labor market, and that all their data was pretty much, and like each FOMC governor um, had different metrics and stuff like that. That seemed to be basically the whole argument. But who knows? Definitely worth looking more into. Yeah, that's pretty much it. Just a speech. I'm like I said, I think he's relatively new. Because I think at some point in here he said something about how like it was his first thing or whatever it was. I don't remember off the top of my head. But anyways, I hope you guys have a good day, and